The bull run, which began in March 2020, is beginning to plateau. Over the past 1 month, the BSE Sensex index has declined 4%, while the Nifty 50 has slipped 3%. But investors should not panic at the moment, as the correction has come on the back of over 30% returns, delivered by frontline indices over the past 1 year. In the broader markets, the returns have been up to 76% during this period. While global headwinds and rich valuations are the key triggers for the ongoing profit booking, the outlook for Indian markets remains healthy on a broad basis. We caught up with Devang Mehta, Head of Equity Advisory at Centrum Wealth, to share his views.
In the past few months, we have seen a fast and furious rally which had led markets ahead of fundamentals, and hence a small correction and consolidation should probably be the order of the day. And that is what we are seeing in the past few days. The reasons can be a flurry of IPOs which are sucking out liquidity from the secondary markets. This money is getting into the primary markets. A lot of FIIs we have seen are getting into the anchor investors mode in a lot of large size IPOs. Volatile crude and commodities across the world have also not helped the prospect of equities in the past, I can say, couple of weeks. Global inflation and interest rates worries also are taking center stage at this point of time. However, if we look at the Indian macros and micros, it's never been so good. The confluence of macros and micros in terms of GST collections, in terms of direct tax collections, I think has sort of set new records. Sentiment post-reduction in COVID numbers, also the acceleration of the pace of vaccination has also sort of brought in a lot of demand. We call it revenge tourism, you call it revenge shopping. I think consumers have started to show confidence as well as the economy has started to sort of bounce back. The return of capex is also a sort of good news for the economy. India INC has sort of delivered good numbers, I think ahead of expectations or in line with expectations in the last quarter as well. However, it can't be a one-way street, right? So structural bull markets always have ebbs and corrections in between.
As pointed out by Mehta, the Indian economy remains on a strong footing and investors should use the correction dip in prices to add quality names to their portfolio. Here's what he suggests.
The way forward has to be the businesses with dominant market share, high ROE, high ROCE, moat, pricing power. All these businesses which have historically done well should form part of the portfolio. The companies which are exhibiting this type of growth profile should be part of the portfolio. Market leading businesses with dominant market shares and companies which probably are not showing that sort of growth should find its way out of the portfolio.
Varun Lohchab, institutional research analyst at HDFC Securities, meanwhile believes the best way to tackle markets is to remain stock and sector specific. He suggests sticking to large cap IT, banks, gas and insurance related stocks. Besides, the brokerage is underweight on consumption, staples, discretionary and autos, NBFCs and small banks. That said, gradual market correction may continue over the near term as possibility of sooner than expected interest rate hike makes investors risk averse. Recently released minutes of the US Federal Reserve's November meeting showed that policymakers are concerned about inflation and are willing to raise interest rates if prices keep rising. The minutes stated that various participants noted that the Federal Open Markets Committee, US Fed, should be prepared to adjust the pace of asset purchases and raise the target range for federal funds rates sooner than currently anticipated if inflation continues to run higher than levels consistent with the committee's objectives. Given this, Philip Murray, who's senior US strategist at Rabobank International, believes that the taper schedule is rapidly turning into straitjacket, preventing the FOMC from hiking rates in time in response to inflation. Consequently, the markets are likely to see an increase in the pace of tapering at the December meeting. Therefore, global markets' reaction to these developments, along with stock-specific news flows and FII activity, will guide the domestic equity markets on Friday. That apart, Tarson's products will debut on the bourses today. Grey market trends suggest a 20 to 30% listing gain.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.